Heya Cryptozens, it's 10 p.m. Pacific time. My name is Nikodemus, and welcome back to the Crypto Overnighter, where we take a nightly look at the crypto, NFT, and metaverse space. And keep in mind, nothing in this show should ever be considered financial advice. It's 10 p.m. Pacific time. The date is November 28th, 2022. Let's see what we got. Jokes are cool. They're an important part of society. That is, until someone doesn't get the joke. And then bad things can happen. This happened recently as some of the crypto Twitter regulars began a joke that some onlookers didn't understand. The joke was that wrapped Ether was insolvent and it was going to lose its peg to Ether. Now, that's only funny because there was some confusion around wrapped Bitcoin. Wrapped Bitcoin and wrapped Ether serve much the same purpose, but they work differently. So people were reinforcing the wrapped Bitcoin in their jokes about wrapped Ether. Jokes that worried some people. These jokes spread as known figures like Anthony Sassano got in on the fun with tweets like, quote, "ETH is nuking because wrapped ETH is currently insolvent." Of course, none of that's true, but it still made the markets worry a bit. Even Bloomberg was taken in with a headline of, quote, "Analysts say some concerns over wrapped Ether emerged too." Anthony Sassano, he came clean with everyone on Twitter. He tweeted, quote, "Wrapped ETH is completely fine. And anyone stating otherwise is joking, being sarcastic, or actually being serious because they don't understand that wrapped Ether is fine." And people were stressing on this. There's some $1.3 billion of value locked up in wrapped ETH. So the idea of wrapped ETH going to zero sounded pretty bad. Sounds bad, but that's just not how it works. Wrapped Ethereum is just Ethereum that's been locked up in a smart contract. You just unwrap it to redeem it. It's entirely under your control, and it's entirely transparent. While your Ethereum is wrapped, you can still view it, which means anyone can check to see that it's fully backed. But it also means that you can verify that it has not been lent out to generate yield, meaning that it's not vulnerable to some hidden liabilities that would make the protocol go bankrupt. Fidelity Investments scored a big win in the world of crypto investing today because after opening up their waiting list earlier this month, Fidelity has now opened up retail crypto trading accounts. The wait is over, their email said. They sent out an email Monday that also explained a Fidelity brokerage account was needed to fund a new Fidelity crypto account. Now, once that's been done, Fidelity is offering commission-free trading of both Bitcoin and Ethereum. So if you were one of the people who got the email, you have to set up that brokerage account. Then you fill out a bunch of disclosures, one of which is a risk statement. And this risk statement says, quote, "Investing in, buying, and selling digital assets presents a variety of risks that are not presented by investing in, buying, and selling products in other, more traditional asset classes." Also included was a reminder that digital asset prices can fluctuate greatly. Instead of charging commission, they're taking a spread of 1% on every trade's execution price. Now, I gotta love Fidelity for this move, because not only are they bringing retail crypto trading to the masses, they're doing so in defiance of government concern. That's because, as we reported, Senators Elizabeth Warren, Tina Smith, and Dick Durbin sent a letter to Abigail Johnson. Abigail Johnson is the CEO of Fidelity Investments. And in their letter, the three senators asked Johnson to reconsider their plan to bring retail Bitcoin trading forward. They said that the industry was too volatile, too chaotic. Bitfront is a crypto exchange that opened its doors in 2020. Well, it looks like their time has come to close those doors. The Japanese social media giant Line announced today that they were shutting the exchange down in order to focus on its native blockchain and their Link token. They said, quote, "Despite our efforts to overcome the challenges in this rapidly evolving industry, we have regretfully determined that we need to shut down Bitfront in order to continue growing the Line blockchain ecosystem and Link token economy." So that means no new signups, no new credit card deposits. And in mid-December, they're planning on suspending additional deposits and payments on their tokens interest products. Instead, customers have until the end of March to withdraw their funds. Line said that they were making this decision in the best interest of the Line ecosystem. And they're specifically saying it has nothing to do with FTX. Now, Bitfront was originally known as Bitbox. It was launched in Singapore in 2018 and it was in 2020 that they rebranded to Bitfront and moved the company to the United States. Aave is also having some troubles. The DeFi liquidity protocol has chosen to suspend the markets for 17 tokens in order to defend itself from high volatility risks that could lead to market manipulation. What happened is the governance members passed a vote, and this vote temporarily freezes assets that are highly volatile and have low liquidity. And these are some big names, including Decentraland, 1inch, and BAT. In addition to those tokens, Aave is also spending a number of stablecoins, including Pax dollars, Gemini dollars, and Liquidity USD. This proposal comes as a result of a failed $60 million attack on Curve Finance using USDC as collateral. Now, Curve Finance is one of those tokens that assets are being frozen. Now, this attack failed largely because they didn't calculate the protocol's liquidity levels. That said, contributors have been working on the project to make sure something like this cannot happen again. Speaking of lending providers, BlockFi has accepted the inevitable and filed bankruptcy. This announcement came today after suspending withdrawals. They announced that they were filing for Chapter 11 bankruptcy. They say that they are hopeful they can restructure and continuing operations in the meantime. Now remember, BlockFi got about $400 million in loans from FTX as a line of credit. Now, according to a press release, BlockFi has about $257 million in cash on hand. Their Bermuda-based affiliate is also filing for liquidation. According to their filing, BlockFi estimates some 100,000 creditors. Estimates are between $1 and $10 billion in terms of both assets and debits. FTX US's legal name is West Realm Shires. Well, it turns out that FTX US is one of BlockFi's largest creditors. They have a $275 million claim unsecured. The SEC, Securities Exchange Commission, also has a $30 million unsecured claim as well. And the largest creditor is Acnura Trust Company, $730 million unsecured claim. Now, everybody knew this was coming. BlockFi was bailed out earlier to the tune of $400 million. However, FTX, who bailed them out, is now in bankruptcy. And then BlockFi suspended withdrawals, specifically because FTX filed for bankruptcy, so there was some question about FTX's assets and what would be available to BlockFi. That led to BlockFi warning their clients not to deposit funds to either the wallet or interest accounts. And BlockFi has had a rough year, right? February this year, and the SEC crushes them with a $100 million fine. They allege violations of both state and federal securities laws. So BlockFi registered their product with the SEC. Then they had to trim about 20% from their workforce in June. And after Three Arrows capital collapse, BlockFi announced that they liquidated somebody. They wouldn't say who. And apparently that liquidation was not quite enough, because then they accepted a $250 million line of credit that would grow to $400 million. Hand in hand with that increase was also something that would let FTX acquire BlockFi. Now, that part of the deal never came about, as FTX had to file bankruptcy earlier this month. As a late-breaking development, the Financial Times is reporting that BlockFi is suing Sam Bankman-Fried. They want his shares of Robinhood. Their claim is that SBF promised those shares as collateral earlier this month. Specifically, BlockFi sued SBF's Emergent Fidelity Technologies. And this complaint was filed in New Jersey, which is the same place that BlockFi has filed for bankruptcy. Sam bought 7.6% of Robinhood earlier this year. And in their filing, BlockFi claims that they entered an agreement with Emergent on November 9th. But also, BlockFi named the brokerage involved. ED&F Man Capital has apparently refused to transfer the collateral to BlockFi. And on the FTX train, the next bit of news comes to us from the U.S. Commodity Future Trading Commission, because there's been some question lately, and those questions are centered around FTX derivatives and the CFTC. Because before everything went south, FTX and the CFTC were in talks about a controversial plan to streamline the market structure's rules. Well, CFTC Chair Rostin Benham is denying that the CFTC and FTX were close to an agreement. Now, typically speaking, trading and clearing are two different roles when it comes to settling crypto derivatives contracts. Well, FTX was proposing to merge those two roles. But of course, that was before FTX imploded. Chair Benham said, quote, "There are elements of the application that I think have merit, but ultimately, we didn't come up with a decision. We were not actually even close because there were more questions." He cited issues in terms of law, policy, and risk. Now, FTX's pitch for this was that by streamlining the process, this lets customers assess and respond to risks in real time. And that idea was called unique by Benham. And he defended the relationship between FTX and his officials as they worked their way through the process. Quote, "FTX and its management team came in quite frequently. As the chairman of the agency, I wanted to be squarely involved to make sure that I was seeing what was happening in terms of the process. But that's not all." Benham also defended the Digital Commodities Consumer Protection Act. Now, he said that if the CFTC gets oversight over spot markets, it would be able to protect crypto investors, because then they can move to stop bad actors. This came after a question about the same legislation that Sam Bankman-Fried was shilling on the Hill. It's Benham's position that the CFTC could not legally supervise much of FTX or their activities, that it would be different under the DCCPA, because in addition to handing responsibility of spot markets over to the CFTC, it would also increase transparency into non-public exchanges. That transparency would help ensure customer funds and company funds don't get intermingled. Benham stood by the bill. He said, quote, "I think it's important that we fill this regulatory gap before more harm is done to retail investors and institutional investors as well." He said that the bill would provide for more direct supervision. That's because the CFTC could require crypto firms to register if they're dealing in digital commodities. And finally, let's take a look at the tiny island nation at the center of the FTX fiasco, the Bahamas, because they've been busy. And I'm not even talking about BitBoy's visit. No, this time we're talking about Ryan Pinder. He is the Bahamas Attorney General as well as the Minister of Legal Affairs. And Pinder said FTX is undergoing an active investigation by Bahamian authorities. Now, this came to us from a statement delivered live on the Prime Minister's Facebook page. Pinder said that FTX Digital Markets was under investigation by civil and criminal authorities. He also said that Bahamian authorities have engaged, quote, "a number of specialists and experts and will continue to do so as the need arises." He went on to say that the Securities Commission and the Financial Crimes Unit of the Royal Bahamas Police Force will be investigating the facts about FTX's bankruptcy and any criminal violations of law. He also said that they would be holding any companies or individuals responsible for any broken laws discovered in the investigation. He said, quote, "These events remind us of the lessons learned from securities and other financial regulation about the need for strong cross-border cooperation. The public worldwide will be best served by a strong international regulatory cooperation." But Pinder is also taking exception to how he feels that his country has been represented in the press. Now, first, he believes that John J. Ray is guilty of misrepresenting the actions of the Bahamas. John J. Ray is the new CEO that FTX brought in to oversee the bankruptcy and reorganization process. Well, in a court filing, Ray and FTX accused the Bahamas of ordering, quote, "unauthorized transactions." The response to that accusation from Pinder was, quote, "It is extremely regrettable that in Chapter 11 filings for bankruptcy protection made in New York last week, that the new chief executive of FTX Trading Limited, not the Bahamas-based FTX Digital Markets, but an affiliate company incorporated in Antigua and Barbuda, misrepresented the timely action taken by the Securities Commission and used inaccurate allegations lodged in the transfer motion that they filed to do so." He also took the time to point out that Standard & Poor's has forecast a stable outlook for the Bahamas economy. Pinder said that there was, quote, "no material adverse impact from FTX's collapse." He said any attempt to lay the entirety of this debacle at the feet of the Bahamas, because FTX is headquartered here, would be a gross oversimplification of reality. "We have been shocked at the ignorance of those who said that FTX came to the Bahamas because they did not want to submit to regulatory scrutiny." And that last bit is an accusation I've heard a few times. The story being that FTX was only interested in the Bahamas because they're soft on regulation. So it is not surprising to me that they don't want to be known as legally lax. Now, it looks like this case is going to give the world a chance to see if indeed the Bahamas is interested in justice or just looking like they are. And that's going to do it for us on a Monday night. I want to thank you, my listeners, because when you stop listening, I will stop talking. We'll see you tomorrow night.